Hello there everyone, today's video is a quick refresher on motor expenses, particularly if you are self-employed. So if you've got your own limited company, you're a director shareholder of a limited company, forget it. I'm not going to talk about that today. I'll do a separate video on that. This is purely if you are self-employed, i.e. a sole trader or a partner in a partnership. So this area actually of the tax law is quite interesting because there aren't many places in the tax world where you get a choice of how you want to be taxed. But this is one of them. You've actually got a choice, two options of how you would like to be taxed on your motor expenses, or rather, how would you like to have tax relief for your motor expenses, because it's a cost of the business, and you actually can choose how you want to do it, and you pick the one that's best for you. But the caveat to that is, once you've decided, you can't change it for that particular vehicle. If you get to year 2 or year 3 and you think, oh, you know what, I wish I'd gone with the other option, tough. But when you change cars, that's when you can reevaluate this options, which I'm about to tell you about. So option 1 is what we call actual plus capital allowances. So simply on this one, you look at the actual expenditure that you've incurred in the year, and you then multiply the total of the expenditure by a percentage being the percentage usage of your car that is for business. So in this example, let's say this sole trader guy, he does 18,000 business miles a year, total miles 25,000 miles, so 7,000 are for personal, 18 for business. That's a business use percentage of 72%, okay? So park that figure. Now we look at the actual expenses that this guy's incurred. So let's assume he spent $3,000 a year on fuel and petrol, repairs, a couple of grand, insurance, £1,000. So he spent £6,000 in the year on running costs for the car in his sole trader business. Now, what you can also claim is what we call capital allowances. And capital allowances are just tax jargon for depreciation of assets. So in this case, you get tax relief for the purchase and subsequent write-off of the depreciation on the car that you've got in your business. So let's just assume in this year, the start of the tax year, this guy goes out and he spends 30 grand on a car. So the rate at which you get tax relief on that 30 grand written off over time depends on the type of car it is. And the rule of thumb is that the more of a gas guzzler that the car is, the longer it takes to get tax relief on that 30 grand of expenditure. And there's actually 3 rates in the tax world that you can get relief, depreciation of capital allowances on. 18%, 6% or 100%. So 100%, which means you'd get deduction for the whole thing straight away, as if it was like, say, an electric car, 100% relief. Gas guzzlers, you get 6%, so 6% of the cost price every year you can claim as a deduction. All the ones in between, which aren't too bad in terms of emissions, 18%. So let's assume in this case, this guy's particular car that he's bought for 30 grand qualifies for the 18% pool, meaning in the first year, he can claim 18% of the 30 grand that he's bought it for as a tax deduction, which is 5,400. Okay, so we tot up the costs. So we had 6 grand of running costs, plus we got 5,400 for the tax write down on the vehicle acquisition. That gives us 11,400, and then to which we multiply by the business use percentage, which we've already said is 72%. So this gives him a total deduction of just over £8,000. So that comes off his taxable profits on which he pays income tax. So that's option 1. So what you would do is assume this is the first year that this car, well it is because we said he's bought this car, assume this is the first year, you do this calculation and then you also do this. You say, right, option 2, easier really in terms of calculation, it's just a flat rate. So flat rate rules, 45p a mile for the first 10,000 miles, then 25p a mile thereafter. So assuming, again, the guy's doing the same mileage, we're comparing the two options, 18,000 business miles a year. So that's 10,000 at 45, 8,000 at 25. That works out at 6,500. So there's these two options. You say, look, well, under option 2, I'm getting a deduction for 6,500. Option 1, I'm getting a deduction for 8,000. Well, it's a no-brainer. I'm going to go with option 1. But of course, every year, or rather every time you've got the new vehicle, it's going to be different, because in year 2, this will not be as high. That will be fixed. That'll still remain the same, assuming HMRC don't play around with the 45p and 25p. But this won't be as good in year 2, because the amount that can be written off will be 18% of 82%. Remember, because it's a depreciating balance, so he's already had some write-off. So every year that he owns this car, this figure gets less and less. So the incremental benefit of option 1 over option 2 will decrease. And at some point, depending how long he's got the car, it could flip the other way, that actually this is still 6.5, but this could drop to 6 or 5 or whatever. But like I said, you can't flip from one to the other for the same car. You've got to wait till you change car. So it's crucial that you do the maths and you kind of work out as well. You can predict what that is going to be with, well, assuming HMRC don't again change these rates, but you can kind of predict what that's going to be. Yeah, fuel repairs and insurance may change every year, but you've got to try and think forward, not just for the current year, and say, well, what's it going to be for the next 3 or 4 years? And that is how you work out tax relief on motor expenses if you are self-employed. Like I said, one of the few areas in the tax law where you've got a choice and you go with the one that's best for you, but once you've decided, once you've done it for the first time for that particular car, you've got to stick with it until you change cars. So if you like this video, please do subscribe, and as always, I'll see you soon.